things too, such as Fibonacci and Elliott wave. So I'm going to show you the relationships between those three different products or different ways of trading and how they all relate with each other too, and how you can use our numbering system to find opportunities, whether you're an Ichimoku trader, whether you're a Fibonacci trader, whether you're an Elliott wave trader, it does not matter to us. Everyone good with that? Okay, so we came up with a numbering system for a couple of reasons, okay? And the very first reason we came up with our numbering system was as follows. We wanted to quickly find opportunities for all global markets. By coming up with a numbering system, you could easily sit there and scan for a number very, very fast for any global market out there, okay? Two, we wanted to avoid trading opportunities. So we wanted to sit there and scan the markets in order to avoid bad trading opportunities. If you think about it, if you keep on looking at crappy charts, you're going to have a very hard time trying to recognize a good chart when it does come, because you're so distressed on looking at so much of the crappy charts and so forth going forward. Okay, so the whole idea is to filter out all the bad opportunities and only see the good ones, and then allow your brain to determine whether there is really an opportunity there or not based on money management and so forth. Okay. Next, you want to basically, the more you look at, well, we already discussed that, so we don't need to go for that anymore. Next, we wanted to diversify. So we want, as I mentioned before, one of the things I believe is that in order to be successful in today's market, today's environment, where you have computer chips being developed at a fast rate and internet becoming more and more prominent, you have to be diversified. You have to be able to trade any product out there and go where the trend is. Okay, and that's one of the things that we harp on, and we've been harping on for the last couple of years. Okay, and then so let's go for the numbering system and let's talk about that. We basically have numbers 1 through 5. If you've seen our website, we have numbers 1 through 5. Okay, each number represents some sort of wave pattern. Now notice one thing. I didn't say Ichimoku strategy. I said each number represents some sort of wave pattern. Okay? So if you think about it, there's a philosophy out there of wave patterns versus indicators. If you notice, a lot of websites and a lot of trading tools out there, they specifically target dealing with trading strategies and dealing with indicators. We're not harping that at all. Okay? We don't believe that you should be creating a tool set specifically based on an indicator. The reason why is if you do, it's going to be very short-lived. Okay, that means it may work now, but it may not work in the past. What we believe is that wave patterns is the way to go. Wave patterns have existed in the past, they exist today, and they'll continue to exist in the future. Okay, so our numbering system is based on wave patterns. Okay, so what we're going to do is we're going to show you the wave patterns in regards to Fibonacci, in regards to Elliott wave, and regards to Ichimoku, and we're going to show you how these numbering systems relate to those three different methods. Because if you think about it, Elliott wave, Fibonacci, and Ichimoku, in theory, we're trading waves. We're using the indicator in the Ichimoku, but in theory, we're trying to trade the wave patterns. So what we want to do is everything that we do from this point on, we want to look at it in terms of wave patterns to help you understand how to use it. So it does not matter if you know Ichimoku or not. If you do know Fibonacci, you'll be able to relate to everything we're doing. Or if you know Elliott wave, you'll be able to relate to what we're doing. If you're trading moving averages, that's not dealing with wave patterns at all. That's dealing with indicators. So you won't be able to relate to what we're doing at all. Is everyone okay with that? Okay. And so let's go forward and show you. Okay. So now, what we're going to discuss are two wave patterns. So what we're going to say is when you have a trend, the numbers are basically going to be 3, 4, and 5. Now don't worry, I'm going to break this down further in just a moment. Okay. But our trend strategies are basically dealing with 3, 4s, and 5s. And if you look at 1s and 2, they're more towards counter trend. And I'll explain these words in just a moment, where I'll define what I mean by trend and what I'll define what I mean by counter trend in just a moment too. Okay, so as I mentioned, we're going to basically look at 3 different wave patterns: a Fibonacci, a Elliott wave, and a Ichimoku. Okay, so does everyone see my PowerPoint says strategy template? Okay, can everyone see we had some type of price movement going down? Let's say this is a bearish trend going down. I don't show you the rest of it to the left of it, but let's say that was a nice bearish move going down, and all of a sudden we're pulling back up. Is everyone okay with that? Okay, now remember, I'm showing you the ideal chart pattern right now. There are variations of this, but I'm going to show you the ideal one right now. So this is a bearish trend here. You have some type of pullback that's occurring. Okay, now at some point it's going to hit a resistance. Okay, and if I sit there and draw it out here, when you sit there and you close above that resistance, we say that basically you broke the resistance. Is everyone okay with that? Yes, in our world, we do not say you broke the resistance unless the bar closes above it. If you have a high that breaks it but closes below that resistance, we do not count that as the resistance being broken. Is everyone okay with my terminology here? You have to have the bar close above that resistance in order to basically say we closed above it, we broke it. Okay? Now, a lot of traders want to trade right when you break a resistance in this example or when you break a support for a bearish scenario. Would you guys agree? So normally you could classify two types of traders. One are the aggressive that want to trade right when it breaks the support resistance, or two, the conservative one where they wants to see some type of upward movement, and then when you get a pullback, they're ready to trade. They don't want to trade right when it breaks the support resistance due to all the games. I'm going to label them to be conservative instead of aggressive. Is everyone okay with that? Yes? Okay? So in this case here, the aggressive trader, when it breaks here, you'll be looking at this. Now, in our system, a numbering system, when you break a resistance and you're an aggressive trader and you want to start trading right away, you're going to be looking at an odd number, a 1 and 3. Okay? If you're a conservative trader where you want to wait for it to go up and the moment a pivot's formed, and then at that point you want to look at a trading opportunity where it would be a pullback here to this old resistance that's now a support, or a breakout trade above that pivot high, you're a conservative trader, and at that point the numbering system is now either a 2 or 4, which is even. Is everyone okay with that? So if you're conservative, you're going to wait for a 2 or 4. If you're aggressive, you're going to wait for a 1 and 3. Is everyone okay with that? Okay? Now, let's take this and look forward. If you're looking for a 2 and 3, what you'll be doing is you're taking a pivot high, add a couple of points. This would be a breakout entry. If you're a pullback trader, your entry would be here at this pullback level, which is this major support there. Your stop is always going to be the major support minus the buffer. That's your set. So this gives you an example of a possible trade setup. Is everyone okay with that? Okay. If you look at the bearish scenario, you have basically upward movement, a pullback. You have a major support there. The moment you close below that support, we say you broke it. The aggressive trader will be looking to enter right then and there, which will basically be looking for an odd number, which will be 1 or 3. If you're conservative, you're going to wait for the pivot to form. Once the pivot's formed, the numbering system goes to an even number, which would be 2 to 4, and that's when an aggressive trader comes up. That's when a conservative trader comes on the board looking for a pullback or breakout opportunity. Is everyone okay with that? Yes? Now, we've described the odd and even, but we haven't talked about, well, would you look for 1 and 3 in the odd, or would you look for 2 and 4? And that's the next step we're going to take in just a moment. Okay? So, now, let's look at trend patterns. The trend patterns are specifically 3s and 4s. Okay? So does everyone see my chart here for this bullish example here? Yes? Okay. Now, in here, This black line here that's going down, we're going to say that's a bearish trend. Okay? And at some point, it's going to stop going down, and people are going to take some profit, which you have a pullback. Everyone okay with that? Now, if you're a Fibonacci trader, you're looking for this pullback to stop either at 50% or 61.8% and then start going back down. Would you guys agree to that? Yes. Okay. So if we mark up this chart here, let's say this is what it looks like right here. Let's say you had a bearish trend here. The 61.8% resistance is right here. So at that point, you're still thinking this is bearish as long as you respect and you're below this 61.8% resistance. Would you guys agree? Yes? The moment it gets above that 61.8% retracement, you're no longer thinking this is bearish at all, and you're going to think this is bullish because it's got a high probability to retrace 100% up to here, and at that point break it and start to go higher. Would you guys agree to that? So if you're a Fibonacci trader, if you violate the 61.8% retracement, in your back of your mind, you're thinking that this is a trend reversal, and in this example, this thing's about to go bullish. Would you guys agree to that? Yep. Okay. So that's the thought process of a Fibonacci trader. So the Fibonacci trader is going to think this is a trend reversal. And normally what a Fibonacci trader will do is wait for it to get to the 100%. Once it breaks the 100%, you're going to look to enter this trade because you're going to think this is a fresh new trend going all the way up. Some aggressive Fibonacci trader will say, okay, as soon as I break the 61.8%, I'm going to enter this to go bullish. You trade it to 100, 127, 161, and so forth to go up. But as soon as it breaks it here, you're going to be entering at some points depending on what type of Fibonacci trader you are. Is that okay with everyone? Okay. The Elliott wave trader is going to be thinking the same way. The Elliott wave trader is going to say, this is Elliott wave 1 right there. This is basically the Elliott wave 1 is right here to this point right here. Elliott wave 2 is right there. And a big institutional wave is the Elliott wave 3 that goes all the way up there. Would you guys agree to that? Now, if you're an Elliott wave trader, you probably haven't found a course at all that teaches you how to trade this institutional wave going all the way up, have you? I didn't. I took courses around the world. I even went all the way down to Australia and so forth, and I took very advanced courses in Elliott wave. I never found a course to show me how to trade the institutional wave, which is 2 to 3. I always found something that showed me how to trade the 4, which is the pullback and the ABC patterns, and the wave 5 after that. But never this institutional wave, which is, believe it or not, is the longest wave out there and the best reward risk. Wouldn't you guys see that? Okay, and that's one of the reasons why Ichimoku got me attracted to everything, is because when I saw Ichimoku, I actually saw how to trade this institutional wave, and that's what I'm showing you today. Okay, so if you look at this in the Ichimoku world, we've gone for Fibonacci and we've gone for Elliott wave, and you look at the Ichimoku world, this is the same representation here. You have a bearish trend here, you have a pullback. The moment it closes above this cloud in the Ichimoku world, we now say this is basically the institutional wave, which is this representation here. This also represents 100% retracement here, and so forth. So believe it or not, whether you're Elliott wave, Fibonacci, or Ichimoku, you're actually trading the same wave pattern, and believe it or not, just different ways of doing it, but you're trading the same wave pattern, which is the big institutional wave going up. Does everyone see that? Yes? So, if you look at it here, as soon as it breaks out of the cloud here, this becomes a number 3. So, if you look for a number 3 in our system, that's when it breaks out of the cloud here for the Ichimoku world. That typically represents the break of the 100% retracement here in Fibonacci, and that also represents the possibility of a 2 to 3 wave moving forward, going up. Everyone okay with that? Does that help with everyone? Okay? Now, what's the difference between a 3 and a 4? If you think about it, this cloud here represents a resistance, just like this 100% retracement here. As soon as it breaks the cloud, it's a 3. The moment it forms a pivot and starts pulling back, which is the first pullback after it broke the resistance, that turns a number 4. Remember we explained the 3s and 4s a minute ago and the 1s and 2s? Right? So if you're an aggressive trader that wants to trade the institutional wave, the big wave that gives you a really good reward risk ratio, you're going to be looking for a 3. If you're a conservative trader, especially if you're brand new to trading, I would stick to number 4s because it avoids all the games being played around here. Okay? It waits for a pivot to form, and then at that point you have time to place a pullback order or breakout order, and you still could capture this big move going up. Everyone okay with that? Okay, so is it very clear in everyone's mind what a 3 and 4 is? Yes? Okay, any questions in regards to this? If you're asking me what strategy I trade, I look for 4s. I don't want to sit there and play games with it here because I come from the institutional world and I know what those machines are doing, and they know that you're looking to trade around these support resistances. I'd rather have it break it, go up, form a pivot, come back down, because by then the machines are bored and moving on to something else. So I personally sit there and look for 4s only. Everyone okay with that? Okay? Let's move on. This is a bearish example here. Same representation of everything we did, but in a bearish mode. Okay, so I'm just going to quickly draw it out, but you guys should see it here. Again, if it's a red 3 or 4, that means it's a bearish opportunity. It broke below the cloud here, or it broke below the 100% retracement here, and which is basically evolving into an Elliott wave 3 pattern, which is the institutional wave going down. Okay. Now, let's discuss number 1s and 2s, okay? So we already discussed 2s and 3s. So let's come here and discuss this. So let me draw this out for you real fast. So would you guys agree that this is a nice bullish trend going up? Mike, I'm not sure what your question is. Quickly changes from 3 to 4. As soon as you break a support resistance, it's a 3. It will remain a 3 until the first pivot's formed and it tells you a pullback starting to occur. Then it goes into a 4. You okay with that, Mike? Varies? What do you mean varies? They vary, yes. One's waiting for a pivot, the other one's not. Oh, it doesn't matter the time frame at all. Remember, everything I'm talking about is irrelevant for the instrument and also time frame. So you could look for 3s and 4s on various time frames, and it's going to be always the same chart pattern. It'll be just a different time frame. Okay. So is everyone okay with 3s and 4s before I move on? So I'm about to get a little more complicated now. Okay? So now, does everyone see this nice bullish trend here? Yes? If you come from the Elliott wave world or Fibonacci world, you'll notice that this big upward trend here basically retraces 38.2% retracement all the way up. Would you guys agree to that? A bullish trend, if you don't know it already, has a lot of 38.2% retracements going up. Okay? Everyone good with that? Okay? Now, the moment that you know, I'm not sure if you guys realize this, but the moment that you break a 38.2% retracement, what's that tell you that's about to happen? it's telling you that a major pullback is about to occur. So until you break this 38.2% retracement, a major pullback's not occurring at all. These little retracements of 38.2% are what you call minor or medium pullbacks. The major pullback will not occur until you break this 38.2. And you may not realize it directly, but if you think about it, you've always been taught to basically wait for 50% or 61.8% retracement, haven't you? Yes? Well, the only way you could really look for that is once you break that 38.2. Once you break this, now you know that a major pullback's occurring. And what's happened is that our system goes into a 1 and 2 as soon as you break this 38.2% retracement, and you're now trading this major pullback to the 50% or the 61.8% retracement. Is everyone okay with that? Yes? Is everyone okay with that? Yes? Okay? So remember, a 1 and 2 is more counter trend because you're going the opposite of the natural trend. The natural trend is bullish here, and what you're doing is you're going opposite, where you're trading bearish in this example here, which is trading the major pullback. And you're only going to do that once you broke this 38.2% retracement. Is everyone okay with that? Any questions in regards to what I just said here? Or is everyone clear with that? Okay? Now, once it gets here, it bounces off and starts to go up. Would you guys agree? And if you're an Elliott wave trader, this is basically your 4 to 5 wave that you're playing. The 4 to 5 wave will come up to here, either to 78.6. It could go up to 100%, 127%, or so forth, which is basically the 5 wave going up. Is everyone okay with this? Yes? Okay. Kirk, I cannot go through all the numbering systems from the very beginning. You could go back to the video and listen to it, but that would be unfair for all the people that have been on this webinar for about an hour. Okay, so if you look here, we've discussed this yellow line here is what you're trading. The moment it turns yellow right here is when it basically is going to be a 1 or 2. And the way you know it's going to be a 1 or 2 is as soon as it breaks the support here, which is a 38.2% retracement, it'll go to a 1. And the moment it forms a pivot and pulls back, it'll become a 2, and it'll remain a 2 until you start all this big nice trend going down. Everyone okay with that? In the Ichimoku world, what this is it basically is this 38.2% retracement is going to turn out to be the Kijun-sen, which is the green line on our charts that when I present. So the moment it breaks the Kijun-sen, breaks below it here, it basically becomes a 1. First pullback it occurs, it'll become a 2, and your goal is to trade it to the cloud, which typically represents the 50% or the 61.8% retracement. Is everyone okay with that? Yes? Okay. So now, we've discussed 1s and 2s and 3s and 4s. Any questions in regards to them? No? I hope it's clear. Now, I'll give you a little hint. A lot of people want to trade the 4 to 5 here in the Elliott wave world. How many of you guys want to do that? Anyone? Okay. All you have to do, if you look at it, the 61.8% retracement of the 50% is going to be bottom of this cloud. That typically represents the Santa-Cal span B. So if you look for price to be at the Santa-Cal span B, you could see this wave pattern here, and you could see that typically it is the Elliott wave 4, and you can start trading it up. Everyone okay with that? If you don't know what I'm talking about, don't worry about it at all. Stick to what I showed you so far. Okay? Any questions so far? Yep, so Darren had a question. So, yeah, if you look for price to B at the Senecal span B, and you see this wave pattern here, you had a bullish trend, it pulled back, got to the cloud, went to the bottom, and got to the Senecal span B, that typically is your 50% or 61.8% retracement. Okay, the good thing is that in the Elliott wave, you don't know if it's going to stop here at 50 or 61.8. In the Ichimoku world, I don't have two options, I only have one, the yellow line. So by using Ichimoku, I'm indirectly trading Elliott wave, but without the subjectivity. Are you okay with that? And I'll show you on the scanner how to look for that once we get to that in just a moment. Okay? Any questions on regards to our numbering system now? Okay? This is the reversal, where this is basically a bullish example here because it's a bearish trend. So I'm just going to quickly throw this up here so you could see the pattern, and you could freeze the video a little later, and you could understand it from a bearish perspective here, or bullish perspective. Okay? Now, let me go for the email alerts. So